Welcome to the webinar on strategies to win in positional trading. So in this webinar, I will be talking about the importance of technical analysis, one. Secondly, I will be speaking on the decision-making tree, that is the right choice, whether you want to buy or you want to sell or you want to stand aside, how you can do that. Thirdly, I will be talking about the different positional strategies, be it swing trading, be it trading, or be it counter trend trading. So I'll be talking about these. And most important, I'll be talking about how to become a pro in positional trading, that is, how to become a professional in positional trading. So these are the four major areas which I will be covering. So first of all, I'll be talking about the importance of technical analysis. So technical analysis, basically what it does is that it is made up of charts. You have chart patterns and which are derived from price and volume. So charts are a window into mass psychology. Just like you have the ECG report which talks about the health of the heart, the charts talk about the market health, the market strength, the market weakness. So when you analyze charts, you analyze the behavior of trading masses, because what happens in markets is that you've got hundreds of thousands and lakhs of traders who are there participating in the markets. So that's a mass of people. That's a huge number of people who are trading or active in the market. So charts basically tries to capture the trading behavior of these masses into patterns. So that's one. Secondly, what happens is that market prices, they are leading indicators of fundamental information, which is why it is known as a discounting mechanism. So what it means here is that any information which is relevant is already reflected in the price at any given moment of time. So all relevant or irrelevant information is reflected in the price at that given moment of time. Thirdly, the price trend of a market revealed on a chart tells us a lot about its fundamentals. So if a stock is moving up and it is continuing to go up and up, so you will find that maybe at that moment of time you don't know the reason why or the fundamentals why the stock is going up, but sooner or later you'll come to know as to what are the major fundamentals which have been driving that particular stock. Likewise, if a stock is correcting, falling significantly, so the fundamental factors or the fundamental reasons why the stock is correcting would also come in public domain. Apart from that, if the technicals are bad, the fundamentals are probably as bad. So if a stock is falling significantly, that means somewhere or the other there is some negative news on that particular stock, some negative fundamentals which are in play on that particular stock, which are impacting that stock. That's the reason the stock is correcting. Apart from that, if you are looking for a market with good fundamentals, find one that's in an uptrend. So if you find a stock which is in an uptrend, so ideally you'll be able to identify some positive or good fundamentals also for that stock. Apart from that, what you need to remember is that technical analysis works across the globe. So be it US, be it Europe, be it Japan, China, India, Pakistan, any country, major country, you can say. And then across asset classes, it could be equities, commodities, or currencies, and also across time frames. So if you're looking at the long-term charts, that is the monthly charts, you could be looking at the weekly charts, you could be looking at the daily charts, you could be looking at intraday charts. So technical analysis works across the globe, across asset classes, and across time frames. What you need to remember, however, is that technical analysis works best in markets which are most liquid. So if you look at technical analysis, you need to understand is that if you can succeed in markets only if you handle it as a serious intellectual pursuit. So you have to be serious if you want to make money in the markets. Emotional trading is lethal. If you're feeling sad and you're going and building a position, or if you're in an angry mood and you go and build a position, or if you are in a very happy mood and you go and build your position, so that's not a good state of mind to be in if you're in the market. So a good trader watches his capital as carefully as a professional scuba diver watches his air supply. So if you want to become a very good trader, you want to excel in trading, then you need to be very careful and protective of your capital. You don't need to be scared, but you need to be protective. You need to be logical in trading. So a trader has to study trends and reversals in the market the way a sailor studies the ocean. So you need to understand, because the market is nothing but an ocean of mass psychology. So you have these high points, and then you have major sell-offs. So that there is fear, there is panic, there is greed in the market. So you need to understand all that. You can never control the market, but you can learn to control yourself. We can learn or develop the art of responding in the right manner. So that's something which is very important for success. So success in the market stands on three pillars. First of all, you need to analyze the balance of power between the bulls and the bears. Who are stronger? Are they the bulls or the bears? So if the bulls are stronger, go with the bulls. If the bears are stronger, go with the bears. So this you can easily identify using technical analysis. And sometimes the bulls and the bears are in you can say equal. So the strength is equal. So in that case, the market is likely to drift sideways. So in that case, you can choose to stand aside. Apart from that, what you need is to practice good money management. Money management is more or less risk management, so I'll be talking about that later. And apart from that, you need personal discipline to follow your trading plan and avoid getting high or depressed in the markets. Because if you get high, means you are too excited, or if you are depressed in the markets, that means you are most likely to take the wrong decisions. So now we talk about the decision making tree and reaching to the right choice. So how do you do that? So there is this system, because basically you have to have a trading plan, you have to have some system in place, you have to have some strategy in place, which will you can say that at many a time in the market there is chaos. So there is and there is and it appears that there is madness in the markets. So by this system and different strategies which you can yourselves identify, you can identify a method to the madness, and you can find some way out which can help you stay ahead. So the ABC system, this system calls for a quick weekly review of all the stocks that you track and sort them into three groups. So you have to identify the stocks and sort them into three groups. So the one which is the A is for those who might think of trading tomorrow. So these are the stocks which you might think of trading tomorrow. Then B for those which you might think of trading later in the week. And C is for those who you do not expect to trade in this week. So you do a quick weekly review, and then you arrive at those stocks which you might trade tomorrow, those stocks which you might trade later in the week, and see those stocks which you do not expect to trade this week. So the best time to run the ABC system is on weekends, when the market is closed, when you're rational, when you're logical. So that way, at the end of the week, you can work for the next week. So in the ABC system, what you can do is, first of all, we look at the A part. So that you look at the monthly chart. So what exactly is the monthly chart telling you? So in this case, if you look at this particular chart, what we are seeing is that you need to identify stocks which are in an upward trend on monthly charts. With the help of you can use the EMA 10 and the MACD histogram. There is a MACD histogram, 12, 26, and 9. They are the default parameters. You can use them. And if you look at this particular uh, green line, this is the 10 period EMA. So the slope of the moving average is very important. And here you can see the MACD histogram. This is below zero and this is above zero. And you can see that the bars are increasing on every month. So effectively, what it means is that this you're looking at the monthly chart of this particular stock. So this is again sloping upwards, and the MACD histogram is positive and increasing. So that means you should be on the long side of the stock, and you should be trading from the long side. So these are the stocks that you will be looking at during the month for opportunities. So this exercise is to be undertaken at the start of the month, focusing on liquid stocks. So what you can do once the month is over, you can identify which other stocks are in a long-term uptrend, and you can on a monthly chart. So those are the stocks which you need to focus the next month. So now looking at the B part of the ABC system, here we are looking at the weekly charts. Again, what we are doing on the weekly charts is that we are looking at the trend of the weekly chart. So we are seeing in this particular chart, and this is of the same stock for the monthly, which we saw earlier. So here we are seeing that the green, this line, which is the 10 period exponential on the weekly chart, it is sloping upwards. Here we can see that the MACD histogram is very strong. Here it is declining. Here it's gone negative, and then here it's marginally positive. So, but so overall, you need to pay attention to this. But this is the best time when the moving average and the MACD histogram, they are both moving up and trending up. So that's the best time. There you'll find the best of the best trends. But here also you're seeing that in spite of this coming down, and here it's becoming negative, yet the stock is going up. So what it effectively means is that the stock continues to go up, but the momentum is declining. But if you look at the moving average, the slope of the moving average, this is very important. So these are the two indicators which you can use on the weekly charts. Likewise on the monthly charts, which I explained earlier. So here on the weekly charts, apart from the 10 period EMA, you can also look at the 20 period and the 30 period EMA. So 20 period, this is the 20 period, and this is the 30 period EMA. So you can look at that. 10 period also you can plot here, but overall I would suggest that you can have a 20 period EMA and a 30 period EMA. This green line is 20 period EMA and this white line is 30 period EMA. So you can use it to identify the slope. And the slope is most important. This is, if you can look here, so what the slope is sideways. So you're seeing what is happening in the market is trading sideways. Here what is happening, it's sloping downward. So you see some selling pressure coming here. Here what you see is that the slope is gradually moving upwards. So here you have the major trend. The slope continues to trade positive, is trending up. So here the trend remains positive in spite of this becoming slightly negative. It is very negative, then you have to be extremely cautious. So this exercise is to be undertaken at the start of the week, focusing on the stocks identified through screen A. So the screen A which I talked about was on the monthly charts. Then you look at the weekly charts and identify the stocks. So these are the stocks that you will be looking at during the week for identifying opportunities. Now we look at the C part of the ABC system. This is the daily chart. So earlier we looked at the monthly chart, then we looked at the weekly chart. Now we look at the daily chart. So stocks identified in screen B are to be analyzed for investing ideas EOD, that is end of day, for the next day. So these stocks, you can say they could close below the Bollinger Band. If you look at the Bollinger Band, this is a 20-period Bollinger Band with a two standard deviation. So here you'll find that this particular stock closes just marginally below the lower band. This is a red band, and this is the upper band, that is a green band. Marginally closes below this. And if you look at this indicator, this is the stochastics. It is a 14-period slow stochastics. So what is happening here is that the stock, this is every bar is a 1 day bar. So you see that the stock closes just below the lower band, Bollinger Band. Next day it closes inside, and here you see the oversold pattern. So it's below 20, and I have taken below 20 and above 80. Some people do 30 and 70, but 20 and 80 they are better because they give you less whipsaws. So what we are seeing here is that this is a point of identification, and here the stock rallies. So towards the upper Bollinger Band, that could be your target level. So SL could be below the recent bottom. So this is, so you can put a stop loss below that, and the target could be the upper band, which I just explained earlier. So this is a very good strategy. You can try it out. You can improvise. You can have your own some additions to this particular strategy. And in case you have questions, you can write to us at webinars@angelbroking.com, and we shall definitely revert back on that. So now we will look at the other strategies, different types of strategies like swing trading, trend trading, counter trend trading. So we'll be talking about that as well. So basically, here I would like is that if you are trading from a very long-term perspective, if you look at this particular slide, so markets are so complex that we must learn to analyze them in more than one time frame. So you don't just look at the daily chart and you buy. You don't just look at the weekly chart and you buy. You don't just look at the monthly chart or an intraday chart and decide to buy. You have to look at least 2-3 time frames. So we just look at the first row. Here what we are seeing, the long-term trend is yearly. So we look at the yearly chart. The intermediate term trend is the quarterly chart, and the short-term trend is the monthly chart. So in this case, we are seeing that the long-term trend is up, the intermediate trend is up. So on the monthly chart, if you are getting a buy signal, we'll go and buy. So this is a trend trading. So you are buying and holding for a long period in the direction of the trend. Likewise, if the long-term is a quarterly chart, that means every bar is 1 quarter. Then we have the monthly and the weekly. So you look at buying opportunities in the weekly chart. So this again, we are going with the trend. Then we have something on the monthly chart. long-term trend is on the monthly chart, intermediate term trend is on the weekly chart, and then we have the short term on the daily. So here again, if we are getting a buying opportunity in the direction of the major trend, so we are saying that we are trend trading. Counter trend could be that we are going against the trend and we are trading. So effectively it means is that if the markets have gone up significantly, if the stock has risen significantly, and we are finding that it is close to some major resistance level, some bearish candle pattern like a evening star doji, or a shooting star, or it could be a bearish engulfing pattern. Some of these patterns could be forming at a resistance level. So the trend still being up, we could go for a short. So that's a counter trend strategy. So counter trend strategy is a strategy wherein you are going against the major trend. So if the major trend is up and you are going short, so you need to understand is that you have to have a stop loss in place one, and you need to book profits fast because you are trading against the trend. So rather, it is better that you trade with the trend, so that was better. Apart from that, we have, just like as I talked about the monthly, weekly, daily, we have, if you're trading from a swing trading short term perspective, that means couple of days. So it's the long term in this case becomes weekly. The intermediate term trend is also called the medium term trend, becomes daily, and your buy and sell signals you get on an hourly. Likewise, on an intraday basis, it could be daily, hourly, 10 minutes or 15 minutes. And those who trade very short term, for them the long term in that case becomes hourly, intermediate term becomes 10 minutes, and short term it could be ticks, that is every tick, or it could become a 2 minute chart as well. So what one needs to understand here is that positional trading, if you really want the secret out what exactly you need to do and how you can trade successfully, so you need to understand here is that what I explained earlier, that first of all you need to look at the slope of the moving average, that is the exponential moving average, and also the slope of the MACD histogram, that is the MACD histogram. If both are sloping upwards, that is MACD is positive, and every bar is becoming stronger than the previous bar, and the slope of the EMA is also up. So in that case, you can say that this impulse system is green. So you have both the EMA and the MACD histogram up. So in that case, it becomes green. So in this case, what you do is either you go long or you stand aside, but you don't short. Likewise, if the slope of the EMA is trading down, slope of the MACD histogram is down, in that case, it is red. Basically, it means that it is red color, so it's a shorting opportunity. So, or you can stand aside, but you don't buy. So, if the MACD histogram is negative and it is increasing, every bar is increasing than the previous bar, and the slope of the moving average is down. So, in that case, you go either short or you stand aside, but there is no buying. And apart from that, there are two other cases wherein if the slope of the moving average is up, the slope of the MACD histogram is down. Vice versa, if the slope of the EMA is down, then in that case, the slope of the MACD histogram is up. So you can see that in this case, it is up and down, and it is down and up. So in this case, either you can go long or you can go short. So in this case, I've just designated blue color, but ideally you are better off if you just concentrate on these two. When both are in up, then you look at buying opportunity. When both are in down, you look at going at shorting opportunity. That gives you a better way to trade, and also your probability of success will increase significantly. So now we come to the last part of the webinar, how to be a pro in positional trading. So in this case, if you really want to be a pro in positional trading, you need to understand is that just buying and selling is not sufficient. You should know that when you are buying, if you're on the right side of the trade, then you need to hold your position. So to be right and to sit tight, that is the toughest thing to do. But this is the only way to make big money in the markets. So if you want to make big money in the markets, you have to ride your winners. You just can't and not sit on your losers. So that's very important. So some of the trades will give you a lot of money. Some will fetch you a decent amount of money. In many trades, you'll marginally make money or lose money. In few trades, you lose some money. But what you need to understand is that some of the trades have to become big winners. Then only you will make money in the markets. Apart from that, what you need to remember is that you can't make money if you're not willing to lose money. So somewhere or the other, there is always a fear in everyone that I should not lose money, I should not lose money. So the more we think about I should not lose money, we are more destined to lose money. So we have to be prepared that it's just like a game of cricket. If you are playing a game of cricket and you are a batsman, So you could either hit a decent number of runs, or you could be out on zero as well. So that's part of the game. So you have to look at the markets the same way. It's just like willing to breathe in but not willing to breathe out. So what it means is that you've taken a breath inside but you're not willing to breathe out. So what I mean here is that if you are in the market, then you have to be willing to take risk. One, you have to be willing to take a loss. Only what you need to ensure is that you don't take such a huge loss that your capital gets wiped out significantly, because that can then damage your chances of, or reduce your chances of success in the markets. Then, apart from that, a professional realizes that falling markets must never be viewed as places to buy cheap unless confirmed by technical. So, just because a stock is falling significantly, say for example, it's fallen from 500 to 400. So you say, and you were initially planning to buy at 500, and now it's available at 400. So you say, oh, it's now cheap, I should buy. No, you should also look at the technicals and see how it is behaving. If the technicals continue to remain in the red, that is, the slope is also the slope of the EMA is also down. MACD histogram is negative and increasing. Every bar is increasing. That means you should not buy. You should stand aside. Apart from that, what you need to know is that you will become a pro when you start spending as much time thinking about exits as looking for entry. So when you're spending initially, what happens is that majority of the people most of the time spend their time on entry. That means I should buy this level, I should buy this level, I should buy this stock at this level. But professionals are those who spend as much time on their exits. Okay, I bought the stock at say 200 rupees. Now where should I exit? What strategy should I use to exit? How can I maximize my profit? These are the questions which a pro asks himself. And apart from that, what you need to remember is that quiet markets put amateurs to sleep and gives the professionals a chance to run away with the market. So stocks which are trading sideways, and then all of a sudden you find that the stock starts rallying and the stock breaks out of a consolidation and rallies, and gap opens with a gap up, and then it continues its rally. So if you are an amateur, what happens is that you'll miss those trades. But professionals, they are very clear that if a market is quiet, then there is a possibility that something sooner could happen in the market. So what you need to understand here is that in this game, the odds are against you, and trading is a battle. When you pick up your weapon and put your life on the line, would you rather be drunk or sober? So this question you should ask yourself. That what I mean here is that you can't be very emotional in the market, because the emotions will kill you in the market. You'll be taking the wrong trades, and you will be losing money. So somewhere or the other, you have to have a strategy in place. You have to manage your emotions in the market. And apart from that, the mental baggage from childhood can prevent you from succeeding in the markets. So our egos, our moods, our weaknesses, our strengths, we have to analyze them critically, and then only we can succeed in the markets. Apart from that, you need to identify your weaknesses and work to change them. You have to overcome your weaknesses, or you need to focus on your strengths. Apart from that, you need to keep a trading diary, write down your reasons for entering and exiting every trade. Also, look for repetitive patterns of success and failure. Why have these trades been successful? Why have these trades been a failure? And can you identify some pattern? If you need help, you can reach out to us at webinars@angelbroking.com. We'll be more than happy to help you. So, in a nutshell, trading is a journey of self-discovery. It is a way of by which we can identify where our strengths are, where our weaknesses are, and what is it that we need to do to evolve and grow as an individual. So, with this, we conclude the webinar. Thank you.